Let me start with a question. What if the thing that's stressing everyone out right now is actually the same kind of moment that created thousands, even millions of new millionaires the last time it happened? And no, I'm not talking about crypto hype. I'm not talking about a secret stock tip. I'm talking about something much simpler: market fear, economic uncertainty, the kind of headlines that make people nervous. Because historically, the last time this happened, when markets dropped, when people panicked, when the news was negative, regular people who stayed calm and kept investing quietly built life-changing wealth. And most people completely missed it. So today, let's talk about what this actually is, why it creates opportunity, and how normal, everyday people, not Wall Street insiders, became millionaires the last time it happened. First, let's define this. This is when markets fall sharply, news cycles turn negative, everyone starts asking, is this the crash? People begin pulling money out, fear becomes louder than logic. It could be a recession. It could be a financial crisis. It could be a pandemic. It could be rising interest rates. The details change, but the emotional pattern is always the same. Fear spikes, prices drop, and most people freeze. Now, here's the part no one likes to hear. Market downturns are uncomfortable, but they are also when future wealth is quietly built. Let's rewind for a second. Think about 2008. Housing market collapse, banks failing, stock market crashing over 50%. People were terrified. It felt like the financial system was ending. But here's what happened next. From the bottom in 2009, the market began one of the longest bull runs in history. People who kept investing, especially regular workers consistently contributing to retirement accounts, saw their portfolios multiply over the next decade. Not because they were geniuses, not because they timed it perfectly, but because they didn't stop. Same thing in 2020. Markets dropped over 30% in weeks, panic everywhere. But what happened after? A massive recovery. Those who kept buying during the drop bought assets on sale, and when recovery came, their growth accelerated. This pattern repeats throughout history. Fear, drop, recovery, expansion. But most people only remember the fear. Why downturns create millionaires? Let me explain this in simple terms. When markets drop, asset prices fall. Stocks become cheaper. Index funds become cheaper. Ownership becomes cheaper. Imagine your favorite store suddenly discounts everything by 30%. If you believe the store will still exist in 5 years, that's a gift. But in markets, when prices fall, people don't see discounts, they see danger. That's emotional investing. Wealth is built through rational investing. When you buy consistently, especially during downturns, you accumulate more shares. More shares equals more growth when recovery happens. That's it. No secret formula, just math plus patience. The real secret: consistency during chaos. Here's something powerful. Most millionaires who built wealth through markets did not time the bottom perfectly, predict crashes, trade daily, watch charts all day. They did something almost boring. They kept contributing monthly. Through recessions, review your emergency fund, make sure it's solid, keep contributing to investments if you can, and avoid catastrophic thinking. Through elections, through wars, through pandemics, they treated downturns as normal, not catastrophic. Because historically, downturns are temporary. Human progress is long-term. Think about it. Despite world wars, financial crises, political instability, global pandemics, markets trend upward over long periods. Why? Because businesses adapt, innovation continues, productivity grows, and investors who own pieces of those businesses benefit. Why most people miss these moments? If downturns create opportunity, why doesn't everyone become wealthy? Because fear interrupts discipline. When portfolios drop 20–30%, people feel pain, and pain triggers reaction. They sell, they wait for things to calm down, they move to cash. But by the time things feel safe again, prices are already higher. Comfort is expensive. Fear is expensive. Discipline is profitable. Let's talk about regular people. You don't need a six-figure income to benefit from these moments. You need three things: consistent investing, time, emotional control. That's it. If someone invested $500 a month consistently through the 2008 crash and beyond, the long-term result could easily reach seven figures by retirement age. Not overnight, not instantly, but steadily. And here's what's wild. Many people who became millionaires during those periods didn't even realize it was happening. They just stuck to the plan. Automatic contributions, index funds, long-term mindset. No drama. Why this moment feels different? Every downturn feels unique. Every crisis feels unprecedented. News will always say this time is different, and sometimes details are different. But human behavior isn't. Fear cycles repeat. Recovery cycles repeat. Opportunity cycles repeat. And the people who understand this don't panic. They position. The wealth gap is often emotional. Here's something people don't talk about enough. The difference between those who build wealth and those who don't is often emotional regulation. Not intelligence, not luck, not secret knowledge. The ability to stay calm when others panic, continue investing when others stop, zoom out when others zoom in. That's the edge. And it's available to everyone. But let me be clear, this is not about gambling. This is not about throwing money into random stocks during chaos. This is about disciplined, diversified, long-term investing. Broad index funds, low fees, automatic contributions, long time horizon. It's boring, but boring builds wealth. So what should you do when this happens? When markets drop, resist checking your portfolio daily. Remind yourself of historical recoveries. Think in decades, not weeks. If you're investing for retirement 20–30 years away, short-term volatility is noise. Noise feels loud, but it fades. Let's shift perspective. Instead of asking, what if the market keeps falling? Ask, what if this is the discount period people talk about years from now? Because that's exactly what people said in 2008 and in 2020 and in every downturn before that. No one rings a bell at the bottom, but history leaves clues. The millionaire formula is not glamorous. Here it is. Earn consistently. Spend intentionally. Invest automatically. Stay patient. Repeat for decades. That's it. And downturns accelerate the process if you participate. The people who quietly became millionaires last time didn't chase hype. They didn't try to outsmart the system. They respected time. They respected compounding. And they controlled their emotions. Let me leave you with this. The next time fear is high, instead of asking, how do I avoid loss? Ask, how do I stay consistent? Because consistency during downturns often becomes the story people tell later. I'm so glad I kept investing back then. Right now might feel uncertain, but uncertainty has historically been the entry point for opportunity. Not guaranteed, not instant, but powerful for those prepared. The last time this happened, regular people who stayed disciplined built serious wealth. The question isn't whether downturns will happen again. They will. The question is, will you panic or will you position? Your future self is watching the decisions you make during uncomfortable seasons. And sometimes, the moments that feel the most unstable become the foundation for the most stable future. I'll see you in the next video.